Hey, we are live on a Wednesday. It's another episode of SNL. My name is Lane.
And I am Scott, the S in the SnL. We're really excited to be with you today, and we're going to talk everything home appraisal. It's a hot topic these days with the market being on fire, and we thought it would be a great time to just dispel some of the myths, give some facts, and just have discussion back and forth between Lane and I in an effort to inform and enlighten.
Yeah, we try to come up with a bunch of different questions that, buyers and sellers both face when it comes to home appraisals. But if you're watching this live and you have a question of your own, feel free to leave it in the comments section. We'll be able to address it. Or if you're not watching it live and you do have a question on something that we didn't touch upon, leave it in the comments section and we'll make sure we get you an answer right away. But let's start at the top of the show, Scott. Let's start with what are home appraisals in general? What are home appraisals?
You know, we all think we know what those are, but let's look first and foremost. A home appraisal is an independent third-party assessment of the value of your home. And most often we're talking home appraisals for the purpose of the lender when there's a purchase going on and the home is going to be financed. That lender wants an independent appraised value of that property to kind of create a benchmark and a litmus test, if you will, as to the value of the house itself. When we generally say a house is worth what a buyer is willing to pay for it, that is correct, but the bank is going to be leveraging themselves with their loan, sometimes up to 70% or more, and they're going to want to have their idea of what the house is worth to determine if it fits with the guidelines of what they want to lend.
Now, does the bank, I guess follow-up question, does the bank get to choose which appraiser goes out there on their behalf, or how does that work?
No, this is a great question. So let's say, and again, we're going to talk basically home appraisals with purchases now. When someone refinances the house, it's the same idea. Their home is going to be appraised. Oftentimes for estate purposes, when one member of a household passes away, there'll need to be an appraised value at the time of the passing to establish where the new basis will be. So there's different times when an appraisal is needed, but for the most part, all appraisals are the same. So to answer Lane's question with regard, does the bank get to choose the appraisal? It's supposed to be an independent third-party situation. So generally what happens is, let's say a home goes under contract and I'm going to be buying that home. I'm financing with XYZ Bank. XYZ Bank is going to get a copy of the purchase contract, and then they're going to order the appraisal. And since the meltdown back in 2008, the industry's been put kind of at arm's length. So there are appraisal clearinghouse companies, if you will, that the banks will put the request into, and then it's supposed to be kind of a random draw as to who the appraiser is that will be assigned to that property. Correct, Lane?
That's exactly correct. It's very well said. Yeah, what they want to do is they want to try to alleviate the bank's kind of controlling of where these appraisals come in at, to avoid what Scott said, the Great Recession of 2008, 2009. And so, yeah, it's pretty much put through a system, and an appraiser is supposed to be picked at random, and it's supposed to be third party and completely arm's length and just provide unbiased an opinion of value, if you will, for that particular home.
Let's talk about that for a moment too, because the appraiser is a licensed appraiser by the state of California, and they will be using documentation, paperwork, forms, structures, if you will, that are consistent across our entire state of California. So every appraisal report is going to have a very familiar format to it. Now, I kind of like to think of the appraisal as an subjective opinion of value based on objective data, because the data that an appraiser is going to use to form their opinion of value is going to be all public record, and that is generally recent closed sales of properties most similar to the subject property they're going to be appraising. And we will dig into that a little bit deeper as well. But again, I want to frame that when what is appraisal. I believe it is, again, an opinion of value, which is subjective, based on an objective set of facts.
Yeah, no, again, very well said. So is there a difference then between a home appraisal and a home inspection?
Let's go ahead and clear that up right away. It's going to be real brief, because those are semantics, and we have both of those situations occurring in the typical home purchase transaction. The appraisal, as we mentioned, is ordered by the bank if there's a loan on the property. And I want to backtrack for 1 second too. Sometimes even an all-cash buyer will say, you know what, I want an independent appraisal of the property just to get a third-party validation of what I'm paying for the house, and we can get into what that means. But the home inspection, and it's generally better to think of that as a physical home inspection, which means that is hiring an independent inspector, a licensed contractor, most generally, that's going to do their third-party inspection of the home. They're going to be looking at everything from the curb to the back fence inside, outside, plumbing, heating, electrical, and safety and code items. So this does lend some clarity, and I'm so glad Lane brought this up. So again, the inspection and the appraisal are two completely different animals altogether. And again, I'm sure we'll want to go ahead and talk about home inspections on another show because it's a very major portion of buying a house. But today we want to talk just about appraisals.
Exactly. And believe it or not, that question of what's the difference between a home appraisal and a home inspection is asked more than you think. So that's why we wanted to touch upon it. And by the way, the home inspector is not chosen at random. It's the buyer. It's somebody that the buyer chooses, the buyer pays for, or the buyer's representative has a referral that they can go with. So it's completely, they completely work for the buyer in that particular.
They absolutely do. Now, as a side note, though, when we get back to our home appraisals, the buyer in a transaction is typically paying for the appraisal because it's done on behalf of their bank. The banks are not benevolent beings that just say, well, we want the appraisal, so we're going to pay for it. The buyers generally agree to pay for the appraisal. It'll be on their estimated net sheet or closing cost sheet that their lender will provide for them before they ever make an offer on a house. So they are going to be paying for the appraisal, but I like that you mentioned that, Lane. The buyer does not have the choice of the appraiser, as we mentioned before.
Okay. Yeah. And so usually the appraisal is a contingency within the contract, right? So the home appraisal, can you explain what it means to remove the appraisal contingency altogether?
I think it's really good because, again, we'll talk more about how they do the appraisal itself, but understanding that the appraisal is one of the 4 or 5 main contingencies generally that's a kind of a standard boilerplate item in the purchase contract, which means if I agree to buy a house for X amount of dollars, I want to have an appraisal contingency on the house if at all possible. And that means if the bank's value comes in below what I have agreed to pay to purchase that house, then things open up again for another round of negotiations between myself and the sellers.
Perfect. So when you're removing the appraisal contingency altogether, you're basically stating that as a buyer, no matter what the appraisal price comes in at, I'm agreeing to pay the price that I put down on the contract.
Lane's right on with that. Lane, why don't you kind of elaborate on that, how that's kind of topical right now, especially in a market where we're seeing upwards of 5, 10, 20, sometimes 30 offers on a property, and buyers are just, they're frantic to get into a property, and they are waiving that appraisal contingency now.
Yeah, so basically when you have 5, 10, 15, 20 plus offers, you almost have to remove the appraisal contingency altogether at a minimum to even have a chance at an acceptance. So you're basically letting the seller know that I'm paying the price. I don't care what it appraises for. I find value at this particular price, and that's what I'm going to pay. Now, if it appraises low, the bank's going to give you a percentage based on that appraisal price. The difference has to be made up out of pocket. So as a buyer, you have to be able to prove to the seller still, even if you are removing the appraisal contingency, that you have reserves in the bank to make up the difference, or that you can structure the loan to maybe where you're putting a little bit less of a down payment to make up that difference as well. So that way you also have to prove to the sellers, if instead of putting 30% down, I put 20% down in the event of a low appraisal, I'm still qualified to make that happen. So those are some of the things that you have to do at a minimum when you're removing the appraisal contingency. Now, the next question that I wanted to bring in is what happens if the appraisal comes in low and the appraisal contingency is not removed? I think we should go over this pretty quickly, and I say quickly because there's a chance if you're going to be buying the next 6 months or so that you're not going to have an appraisal contingency on the contract. But let's say you did not remove the appraisal contingency, then this is another negotiation point in escrow where you can negotiate the price. You can go back to the seller and say, hey, it appraised $30,000 lower than what we're under contract for. I do not want to pay higher than what it appraised for. Or sometimes the buyer and the seller would meet in the middle and negotiate between the contract price and the appraisal price, or the seller has the authority to say no and say you're paying the contract price, otherwise you can get up and walk. But you can use that contingency within the contract to be able to walk away if it does appraise low, and you do still, in fact, it'll be rare, but have that appraisal contingency in play.
So I think Elaine's absolutely right. Let's put this into an example. So let's say that I am buying a house and I agree to pay $900,000 for the house. That's the contract price that I've agreed on between myself and the seller. The bank comes in and does an appraisal, and that property comes in at $850,000, $50,000 below what the contract price was. So the options that I as a buyer have, again, we'll turn it around, that I have as a buyer is to say, well, I'm going to walk away because now the bank says it's worth $850,000, and I concur with that. I no longer want to purchase the house. I can do that. I can B, go back to the seller and negotiate and say, I would like you to reduce the price to 850 because that's what the bank has said. So that's like the best case scenario for a buyer. Most likely in cases like this, we see some sort of a compromise and the meetings of the mind can be in the middle. Again, that's if we're not in an uber competitive marketplace like today. Generally speaking today, if I go back and want to negotiate with the seller, he or she is going to say, well, you know what? You were one of multiple offers that got chosen. I've got people waiting in the wings that I'm sure would be willing to waive the appraisal contingency, or they're probably going to feel lucky enough that the next buyer in line, if chosen, isn't going to worry about that. And so it's unlikely, we don't want to set an expectation that the buyer is going to really prevail in today's marketplace with regards to that. Just one quick note with regards to the buyer's options when the appraisal does come in low, and that is your banks. Again, you have that loan to value, and most Fannie Mae and Freddie Mac loans are designed around an 80-20 model. So the loan to value needs to be 80%, 20%. So their model is going to be based on that, and that's where Lane was mentioning. Sometimes you'll need to bring in cash to keep that ratio in play. Sometimes you'll need to reduce your down payment and accordingly. So we just want to be really clear about that. So let's say if I'm putting 50% down and the appraisal comes in low, I have enough cushion within most loan programs that I'm not going to have to go into pocket and put any more down. But I'm understanding that the bank, again, in their opinion, says that the value is lower. One other thing, and we can touch on that, Lane, I want to ask you is, what are the facts and figures? What is an appraisal based on? What data does an appraiser use when he or she is coming up with their opinion of value? And why is it common right now that they may be coming in lower than the agreed upon purchase price?
Yeah, there's so many factors that are in play here. You're looking at the condition of the home. You're looking at when the comparable sales have closed, and they generally don't like to go any further than 6 months back. But let's think about 6 months back. We weren't even in 2021, right? So we were at the end of the year, and it feels like a completely different market 6 months back. So you have to think about, an appraiser has to as well. And that's why it's actually really important for the listing agent to be present at these appraisal appointments, because they can remind these appraisers that, hey, if you're using a comparable sale that happened 5 months ago, it's a completely different market. They look back more so than they look in the future. But if you can prove to them the trajectory of where the market is currently and where it's going, they can use some of those factors as well. They look at bed count, bath count. They try to stay within a mile radius, but they look within the community first before they dip out of the mile radius. And they try at the best that they can to look at close. But lately, because of how crazy things have been, appraisers have been really good about using pending sales and some of the active ones if they've already received offers that are above asking, and they're getting information from those listing agents to determine where those ones are going to go under contract for when they're determining their valuation. Now, on appraisal reports, there's typically 6 comparable sales. The top 3 comparable sales are weighted higher. So that's why when listing agents like ourselves are present for the appraisal appointments, we're bringing at least 3 comparable sales that we think will be best suited for that particular sale to help the appraiser, and we want those ones to hopefully be weighed a lot higher and be the top 3 comparable sales in that particular report.
Exactly right on, Lane. And let's clarify that just a little bit. Again, keeping in mind the appraiser is an independent third party. They may be somewhat familiar with the geographic area, but they're not required to be a local specialist at that point in time, or for that individual market. So they'll have access to the same database we'll have, but they may not have the intuitive kind of local guy or gal's knowledge of what's going on. So it's really important that your agent, if you're a seller, is going to be kind of your advocate and be at that appraisal appointment with their own set of comparables, as Lane had mentioned, because sometimes, their egos aren't too big and they welcome our insight as the local experts to say, you know what, we feel these 3 comparables, for example, should have more weight, and here's why. For example, they're in the same development. The lot sizes are very similar. The locations are very similar to our subject. As we know here, location plays a big factor in value, whether we back up to a green belt or we back up to a 6-lane highway. That can affect value. Same thing with lot size. In a perfect world, an appraiser would like to see every comparable be identical to the subject property. That's not really in reality. Then the other point I want to make from what Lane said is understanding the appraiser's job historically has always been as a forensic analyst. And forensic, of course, means analyzing something in the past. And when the market in the past is somewhat static and similar to where it is today, that job is easy and there's not much disparity. To Lane's point, everything's out the window because even 120 days ago, the market was completely different than it is now. And the appraisers are risk averse. They don't want to make any mistakes, as happened when the market was accelerating and then crashed back in 2008. So there's also kind of some built-in armor, if you will, to not overinflate the value based on a perception of the current market.
Very well said. Very well said. Well, sticking with the appraisal contingency theme, let's say the appraisal comes in higher than the contract price. Is there anything that happens then?
I say winner, winner, chicken dinner for the buyer, because the seller does not have the option to renegotiate to a higher value. The buyer generally has built-in equity. Not generally, absolutely, by definition, the buyer would have a built-in equity. Let's say we agree to pay $850 for the house and the appraisal comes at $900,000. Again, it is an opinion of value, but your bank's going to be happy. You're going to be happy. The seller, sometimes not so much, but again, there's no renegotiation in place. So it's really a win for the buyer. It's not a lose for the seller, because we think about it, until the moment the appraisal came in, the seller was generally quite happy with that price because they agreed to accept it.
Yeah, that's exactly right. But it's rare. It's rare. You're probably not going to see that too much in this marketplace. But Scott and I are master negotiators, so you never know if we're helping out the buyer. Then maybe you do get something that comes in higher than the particular contract price. But the seller may not even see that altogether, by the way, either, because that report is paid for again by the buyer, and the only time the buyer normally forwards that appraisal report to the seller is if it does come in low. If it comes in at what we call at value or higher, a lot of times the buyer is going to be sitting on that particular report and not necessarily sharing that knowledge and keeping that knowledge for themselves. So that's something that could potentially happen if it does appraise higher than the contract price.
And Lane's got a great point. It's pretty rare right now as well. And from the seller's perspective, the seller today is, kind of on pins and needles to the appraisal comes in, hoping that it's not going to be low, because most likely, buyers are tipping the scales a little bit more to the emotional side because of multiple offers and bidding these prices up. But I think we should probably go back, Lane, to help buyers in today's market understand just a bit more with regards to the fact that although we're talking about how the appraisal can help them and give them a safety valve and so forth, the realities in play right now are that what percentage would you say of buyers are waiving the appraisal contingency altogether? And then what are some other ways that they can kind of get around this?
Well, I would say as far as percentages that are waiving the appraisal contingency altogether, if you're financing and you've bought a home in the last 4 to 6 months, you're probably 90%, 100% to 100% of the home buyers that are waiving appraisals. It's basically what you have to do to even have a chance in this marketplace of getting an acceptance, because we did a show last week about how many all cash offers have been flooding the market as well. So to compete against these all cash offers who don't have to get a loan, who don't have to have an appraisal, you're going to have to do the same thing to compete with that. Yeah. Now, I think what Scott's getting to, which is perfect, because this is my next question, is let's say I'm a home seller and I'm accepting an offer from a buyer that waived the appraisal contingency. Is there potential, I don't know, maybe game playing that I have to watch out for on the buyer side that I can, try to avoid? And here's the thing, there's, like Scott mentioned at the top of the show, there's 4 or 5 different main contingencies, right? You have the investigations contingency, the loan contingency, the CC&R and HOA docs, you have reports, you have the appraisal contingency. So if I'm waiving the appraisal contingency altogether, and it doesn't appraise, are buyers going to be using other contingencies to try to back out of it? And Scott, you can come in and have the conversation with me as well. But are they using anything else besides appraisal to get out of it? And we're hearing, and that might be the case of, somebody said, you know what, I'm just going to use the investigations contingency as my reason for backing out if it appraises low. So I'm okay taking the risk of removing the appraisal contingency.
Lane is absolutely right on with this, and this is where the buyers and the sellers especially have to have eyes wide open and understand, by definition, how contingencies work in the purchase contract. And the other contingency we want to make sure we mention is that loan contingency, and that's the time from the original loan application to final sign-off and approval when they're cleared to go to loan documents. But everyone needs to understand in a purchase transaction, buyers and sellers alike, that it's kind of like bowling pins. There's all the contingencies, each pin to fall, but the buyers can use any contingency to walk away from a contract. So when we talk about game playing, let's be honest about this. For example, it's the longest time frame contingency out there that's the last one to go down. So let's say we have all our contingencies in place. We've got an appraisal contingency waived, but let's say, for example, we have a 17-day investigation contingency. That would be 17 days for the buyers to do all of their investigations of the property and satisfy themselves as to the condition of the property. Now, that seems like a horribly long time. It's the default number in the contract, and that's another show for us how we reduce that. But let's just say that was left in play. That means the buyer would have 17 days to use that as a reason to back out. So let's say the appraisal came in, for example, $50,000 low, and the seller says, well, I'm not going to negotiate on that. And they waive the contingency altogether. Let's just say, I'm getting a little tongue tied. They waive the contingency altogether, but it comes in $50,000 low, and the seller's going to think, well, I have the buyer because they waived that contingency. If they're still within one of the other contingency timeframes, let's say such as investigation, even if the property was completely clean, the buyers could say something like, oh, I didn't realize these trees in the backyard block the sunset at 5 o'clock at night. I don't want this property anymore based on that. I hate to say it, but it's that subjective how that can work. So contingency timeframes need to be tightened up, and I think to benefit both parties in a transaction. Lane, thoughts?
Yeah, no, that ties right into our final question of what are some things that we can do to prevent some of the game planning that could potentially go on, and that is tightening up a lot of the contingencies there. Because let's use Scott's 17-day investigations example as well. There's a couple other things at play here. There's something in the contract that states that if you get any reports or disclosures, you have 5 days to review them no matter when they came in. So if they came in at day 17, you have 5 more days on top of that. So it could potentially go on beyond that too. So there's tasks that your listing agent has to do ahead of time, whether it's coaching you to get the HOA docs ordered quickly and on a rush. And there's also things that you can do when you're in the counteroffer process where instead of using those 5 extra days for review, you can shorten those to 2 or 3. The notice to performs, when you get sent a notice to perform, you have 2 days after receipt of the notice to perform to remove that contingency. You can remove that to 24 hours, but then you can also send that notice to perform 2 days before they're even due. So there's things that your representative on the selling side can do to avoid these game playing in addition to just tightening up the contingencies. There's terms in the counteroffer that we can set that would benefit the seller at hand to make sure that whatever offer we are accepting, it's going to be very, very hard for them to be game players with us.
Absolutely. And if we flip that around to the buyer's side, we have to remember there's a level playing field for both sides. So let's say you're a buyer and you happen to have someone on the seller side that's as in tune with everything as the Sackin-Stone team is, and you get a counteroffer back with reduced time frame for all of your contingencies, reduced time frame to review documents. To be honest, everything in the contract is so far, in our opinion, exaggerated and almost made for the lazy person. But any good buyer's agent is going to be able to make sure that they're still protecting their client, that there's plenty of time. There's no more needed time than 24 hours to review documents, quite frankly. And there's no more time needed than about 7 days to get your investigations done, unless you have to hire a specialist after the fact. Then you've built in some time that if you need extensions, you can ask for it. The buyer is never going to be in jeopardy, but generally speaking, tight time frames are better for all parties concerned because it just keeps it businesslike and it keeps things moving. And with good agents on both sides, they can just make sure that they're driving the schedule and things happen quicker, things stay in play. And if something is going to fall out, it's going to happen in the early stages and both buyer and seller can move on.
Exactly right. And if you are a buyer, then one of the things that you can do when you're in the counteroffering process to make you look even stronger is basically call the listing agent and say, not only can I accommodate your 7-day investigations contingency, but I already have my inspector penciled in for 2 days from now or tomorrow or whatever it is. And then now you're telling them and showing them how committed the buyer is, what you're doing already ahead of time before you even have an acceptance, on showing them that you are going to do everything you can to meet the timeframes that are in the contract. And that's going to make a listing agent feel so confident and comfortable going with you because they know that you're not going to be messing around. You're not going to be game playing and that you're already ahead of the game.
I hope today that we've really shed some light on the appraisals, but also shed some bigger light with the umbrella of how the appraisal contingency works in the broader spectrum of contingencies within the purchase contract. The purchase contract is how many pages long now, Lane?
I think it's up to like 15 if you count some of the disclosures.
There's a reason that it's so many pages long and it's fraught with so many ins and outs and twists and turns. But with folks like the Sackin-Stone team and many other great agents out there, you're in good hands as a buyer and a seller to navigate all that. But the appraisal is one of those foundational contingency timeframes here, and that's why we want to tie in with what is an appraisal and how it ties into contingency timeframes today. I hope we've shed some light on that. And as Lane said at the top of the show, if you're watching this after the recording, please reach out to us in any way at all that we can enlighten you even further, or if you have particular questions at all.
Exactly right. And if there's something that you or somebody you know might have found value in today's show, please share this episode with them. We love doing these shows every Wednesday, same time, same place. And I can guarantee you we're going to be back next Wednesday at 11 as well for another episode of SnL. As always, my name is Lane.
And I'm Scott.
Thank you so much for watching, and we'll see you next week.
Have a great weekend.